So, good morning to everyone. Hope you could hear me. And today we are going to discuss about profits and gains from business or profession under the Income Tax Act 1961. You all need to understand. Many students has the problem of the moment we say PGBP. It is very difficult, and the approach is finding it very difficult. But please understand, the basics should be very strong for you. What is profits and gains from business or profession? You need to understand. Whenever there is a business, whenever there is a profession, it comes under this section 28 to section 44. You need to be very clear. Section 28 to section 44. Now, what is section 28 is a chargeability section. When you read Income Tax Act, in any provision of Income Tax Act, remember, Income Tax Act is a rule. It is a formula. You cannot change the formula. For example, we all know A plus B the whole square formula. I presume A plus B the whole square formula you all know from your schooling. You cannot change the formula. In similar terms, Income Tax Act is being designed, is being specified by the income tax authorities, Finance Ministry of India. So you cannot change or you cannot invent your own act whenever you read Income Tax Act. Not only income tax, any law for that matter. Whenever you read law, you think it is a formula. You cannot change the formula. And it is a direction being given in the act. A plus B, A minus B. In simple terms, whenever you read an income tax act, make sure you are following a formula. You cannot change the formula. I get into the subject now. Profits and gains from business or profession. I repeat, 28 section to section 44. That is profits and gains from business or profession. Like I started, you need to know what is a business, what is a profession. For example, if a person buy and sell, it is trading. If a person creates something by its own, it is manufacturing. If a person uses technical skills and give consulting to some other, it is a profession. What is business? What is not business? You need to understand. I will give a classic example. A person has three house properties. A person has three house properties. He sell two house property, for example, for want of his daughter wedding or some emergency situation, he sold the house property. He is selling his own house property. It means it is a sale of capital asset which will fall under section 45 of the Income Tax Act under capital gain. The same person, same example, three house properties. He sold two house property. He bought again two house property. Again he sold two house property. Again he bought another house property. The time interval, what he is doing is 3 months to 6 months or continuity in nature. It means the intention of the person is doing buying and selling of house property. That comes under business section 28 to section 44. So the intention of each transaction to be seen whether to consider that as a business or to consider that as a capital asset. So this should be your mindset. As a student, you need to understand the basics and it has to be very, very strong because once you miss the basics of the Income Tax Act, you cannot proceed further. And even if you proceed further, at the time of examination or at the time of solving a problem, you will find it difficult. So have the basics very strong. Now, section 28, chargeable section. What is chargeable section? In every act, the chargeable section is the section which stipulates what is, for example, in our discussion today, what is profits and gains from business or profession? That is chargeable section. Okay, and chargeable section means profits and gains of any business or profession. Well, one more thing I want to highlight here. Whenever you read Income Tax Act, make sure you read line by line, word by word, because that has a change in your examination answers also. Some students think this section is applicable for all the assessees. Some students think this section is applicable only for individual and HCF. So make sure whenever you read only once, I'm not saying every day you need to read line by line. The day you start this subject, the day you start your preparation, try to make sure that you read line by line. Now I read section 28, chargeable section. What it states: the profits and gains of any business or profession, I repeat, any business or profession carried on by the assessee at any time during the previous year. So here, any business by the assessee who is doing any business or profession. This should be your starting point. So profits and gains on business or profession, any business by any assessee. Now it has been defined what is specifically to be considered, what is to be specifically considered for business or profession. In that, there is section 28, subsection 1 I spoke about. Section 28, subsection 2 states any compensation or other payment due to or received by a person at or in connection with termination of his management. First point, termination of his management or modification of the terms and conditions relating thereto in the person is a managing director or a whole or substantially the whole of the affairs of the Indian company. It means the person is getting some compensation for termination of his management, and he might be a director of a company who is getting compensation. That is a profit and gain arising out of business or profession. One more question will arise in the student's mind. Sir, when there is a compensation received by the director, should it not be a salary income? Yes, it is a salary income. But section 28 sub clause 2 specifies very clearly termination of his management or modification of the terms and conditions. That is very important. The second point is termination of his office or modification of the terms and conditions relating thereto in case the person is managing the whole or substantially the whole of affairs in India of other company. Earlier point was an Indian company, the same company. This point is for other company. Third point, termination of agency or modification of terms and conditions relating thereto in case of a person is holding an agency in India for any part of activities relating to business of any other person. So you need to be very careful in reading these points. Why I am reading all these points is this is the starting section, chargeable section, section 28. That is the main reason I am reading it. Other sections I will explain you one by one. Fourth point, vesting in the government or in any compensation, vesting in government or in any corporation, owned and controlled by the government under any law for the time being in force of the management of any property or business. I'm reading the provisions of the Act just to make you understand. The last point in this section is termination or modification of terms and conditions of contract relating to his business. So, for example, when you have a contract, you're going to terminate the contract. Will that be a business income or will that be a, because it will be a one time when there's a termination of a contract, when you have a contract with somebody to do a certain events and if that breach of contract comes, the compensation received in relation to the business contract, then the termination money received is a business income. So you need to be careful. 28 subclause 3. Income derived by a trade, I repeat, income derived by a trade, professional or similar association from specified service performed of its members. So income derived by a trade, professional or similar association from specified services performed for its members. When there is a specified services provided for its members, that income will also be and comes under profits and gains for business or profession. Now, the fourth point, section 4, subclass 4. In the case of an SSE carrying on export business, in the case of an SSE carrying on export business, what is profits PGBP comes under? Profit on sale of import entitlements. Profits on sale of import entitlements. It means the benefits which you receive on imports. Cash assistance against export under any scheme of Government of India. Customs duty or excise repaid or repayable as drawback. Profits on transfer of duty free free replenishment certificate. Value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of profession. Sixth point, any interest, salary, bonus, commission, or remuneration due to or received by a partner of a firm from such firm. Any compensation, interest, salary, commission received by a partner. I repeat, if I am a partner, I am getting remuneration, I am getting interest, everything from my partnership firm. It is income from business or profession. Any sum received or receivable in cash or kind for an agreement, not carrying out any activity of a business. See, this is a very important point, and you need to know that this is in the business terms they call this as non-compete fee. For example, if I am doing a business, I want to get retired, I sell my business, I value my business, I sell my business. Apart from that, the buyer who's buying my business, he might ask me, you might ask additional money so that you should not do the similar business. So non-compete, it will be for 3 years or 4 years or 5 years, there will be an agreement. The buyer will pay me additional money apart from my company valuation. That money is for me not doing business. I repeat, for the money received is for not doing business by me for a period of 3 years or 5 years. Now, what not doing business? So it means, should I not do business? You can do business, but you cannot do the similar business which you sold to somebody for a period of 3 years or 5 years, depends on the agreement. That is called non-compete fee. Section 8. Any sum received under Keyman insurance policy, including the sum allotted by way of bonus on such policy. Keyman insurance policy. Keyman insurance policy means for directors or very key personal employees in the company take policy in their name. The money which they receive, that is the employee or a director receive against Keyman insurance, that is comes under business or profession income. Fair market value of inventory as on a date at which converted into treated as capital asset. When there is a asset, that is inventory in your books, and the fair market value of the inventory as on a particular date in which it is converted into treated as capital asset. When the stock is being treated as capital asset, that value should be business or profession income. Last point, any sum, whether received or receivable in cash or kind or on account of capital asset other than land or goodwill or financial instrument, being demolished, destroyed, discarded, or transferred, in respect of which the whole of expenditure has been allowed under section 35 AD. So it means 35 AD, we will discuss that when we come to 35 AD, so that you will know what is 35 AD. Now, when you do a business, now comes the real sections to be discussed. What we discuss now is the basics. From now on, I will tell you the section and I will explain you the section. Now, when you do business or profession problems, when you read those problems, what is very important is, when you have a business, what are the expenses being allowed? For example, when I do a business, I repeat, when I do a business, I have to pay salary, I have to pay rent, I have to pay electricity, I have to pay insurance premium, I have to maintain my assets, I have to maintain my building. So these are the normally acceptable expenditure for doing a business, which everybody knows. For example, when I'm buying asset, will that be capitalized or will that be expensed off? Obviously, we will capitalize the assets. We capitalize the assets. It means we will show this asset in the fixed assets and we will claim depreciation. That is allowed. For example, I'm having a person working under me as a personal assistant. I am the managing director of a company. I'm a managing director of a company, and I am having a employee who is my personal assistant, right? Who is my personal assistant. Now, that expenditure is personal in nature and not for my business. So, the salary paid, I repeat, the salary paid, I repeat, the salary paid to that person should not be allowed as business expenditure. This should be your target. Now, now slowly we are getting into the provisions of the Income Tax Act. Admissible deductions. In profits and gains of business of profession, what is admissible, what is not admissible? You need to have the terminology is also very clear. I would, from now on, I will say admissible expenditure and allowable and disallowed expenditure. You need to know what are the terms. Admissible means, like I told you, rent, electricity, insurance premium, anything for the purpose of business or profession. That should be your mind. Whenever you read a problem, you make sure whether that expenses is being allowed or allowable for the purpose of business, then it is allowable. Otherwise, you need to disallow. What is the question of disallowances? For example, the same example. I have a profit of 1 lakh rupees after all my expenses. I repeat, I have a profit of 1 lakh rupees after all my expenses. I came to know in the adjustment that one employee salary of 10,000 rupees, I repeat, one employee salary of 10,000 rupees is being for personal expenditure. Now the profit has been arrived, the 1 lakh profit has been arrived after showing the 10,000 expenditure. Now, what you need to do, the moment it is not an allowable expenditure, what you will do is 1 lakh as per profit and loss account, you need to add back that 10,000 rupees because it is not allowed. Students will get confusion. I repeat, 1 lakh is the profit as per the problem given. Profit after all expenses 1 lakh. In the adjustment, they are saying 10,000 rupees. I repeat, 10,000 rupees is not an allowable expenditure because it is a personal expenditure. So this 1 lakh is after reducing 10,000. So you need to add back that 10,000. So total revised profit will be 1 lakh 10,000. So you need to have this basics in mind. When the expenses is to be disallowed, it has to be added back. When the expenses is not been allowed, when you are allowing again, you need to reduce it. So this should be your mindset. Now, section 30. I'm going into the section 30, admissible deductions, section 30. Like I said, section 30 stipulates any expenditure incurred for the purpose of business, rent, rates and tax, repairs. I repeat, for the purpose of business or profession, underline the word purpose of business or profession. You have to allow expenditure only if it is for the purpose of business or profession. That is very important. Now, one more question we'll have. There is something called capital expenditure and revenue expenditure. So revenue expenditure are recurring in nature. So many students have a problem when there is a revenue expenditure is recurring in nature. If anything is one time, will that be allowed or not? The nature of expenditure is very important. You need to ascertain whether the expenses is for the purpose of business or profession. It is not that only one time you spend some expenses and it is not an allowable expenditure. For this one classic example I can give you, when there is an annual day function in a company. Every year there is an annual day function in the company, let's say they have expenses of 1 lakh. This is one time expenditure. But this annual day expenditure is for the purpose of business or profession, allowed as business as professional expenditure. So that should be your intention. That should be your mindset. So Section 30 stipulates basic expenses allowable. Section 31. Section 31 stipulates amount paid on account of current repairs and insurance for machinery, plant and machinery, furniture used for the purpose of business or profession. So repairs, insurance premium, all those expenses are allowable expenditure. Section 31. Coming back to the main section, section 32, very, very important in terms of any examination. Section 32 is important because section 32 deals with depreciation. Section 32 deals with depreciation. In depreciation, there is something called, students might find it difficult only in one area, which is called block of asset. I'll just explain what is block of asset. Unlike Companies Act, Income Tax Act has given specified rates for deducting depreciation or calculating depreciation. What is that? 10%, 15%, 20%, 30%, 40%, 60%. There is a depreciation rate being given. For example, what is block of assets, sir? Many students ask. Block of assets means I have a car. I have a car I use for my business, and that car is depreciated at 15%. I'm buying one more car for my office. I'm buying one more car for my assistants, for traveling for audits or other thing. Being a chartered accountant, we will have audits across India. Let's say they need to travel with our own car. So 3 cars. You will not show the 3 cars separately, and you will show the 3 cars in one block under motor car. So motor car, 3 cars will be shown separately. So block means you need to fix the block based on the rate. I repeat, based on the rate. For example, car is at 15%. There is a tempo or a lorry used for goods. So when a manufacturing company has vehicles and lorries or trucks, these two are separate block, and one is at 15% and the other will be at 30%. So block is based on the rate of depreciation. So that should be your mindset. And when you do problems, there is one important criteria under Income Tax Act which you need to follow. What is it? When the asset is purchased, I repeat, when the asset is purchased on or before 30th September, on or before 30th September of that year, then the full rate of depreciation is being allowed. I repeat, when the asset is being purchased on or before 30th of September, the full rate of depreciation is allowed. What is full rate of depreciation? For example, I told you one car depreciation is 15%. Now, the car rate is 15%. You are buying the asset on 30th September. Exactly on 30th September, you are buying the car, you are having the invoice, registration is completed. Now, 30th September, you bought that asset, you can claim 15% fully for that year. I repeat, you can claim 15% for that year. For example, you could not able to do the registration, you could not able to buy the car by 30th September for whatever reason. You are buying the car, I repeat, you are buying the car on 1/10/2020, let's say. I repeat, 1/10/2020. It means you can claim only 50% of the depreciation. It is a question of one day, but Income Tax Act says if your asset is bought within 180 days, that is 30th September, claim full depreciation. If your asset is bought after 180 days, that is 110, from 110 to 31st March, you can claim only 50% of the depreciation. In our example, as I told you, car is depreciated at 15%, and 50% of that is 7.5%. So you can have depreciation for that year only 7.5%. So this criteria you need to be very careful. Under Income Tax Depreciation, Section 32, I repeat, Section 32, block of assets, I told you, 180 days full depreciation, not 180 days, half the depreciation. Be very clear. Now the next point is very important. Additional depreciation. This is a new thing, or I would say new benefit which has been introduced by the Income Tax Act, and it is since 2005 to promote business, to support business, and many factories, manufacturing units are dependent on machineries, huge volume machineries. The additional depreciation is also being given. This is a benefit to the companies. What is additional depreciation? Section 32(1) subclause 2A, additional depreciation stipulate 20%. I repeat, this is examination oriented. For any examination, additional depreciation has a vital role. Please be very careful in noting down the year from which it has been allowed. So, additional depreciation of 20% of actual cost of plant and machinery. I repeat, actual cost of plant and machinery acquired and installed. Underline the word acquired and installed. Here there is an issue. You bought the asset. Acquired and installed after 31/3/2005. After 31/3/2005. By an assessee engaged in the business of manufacture or production of any article or thing, or in the business of generation, transmission, or distribution of power shall be allowed. So it means for power generation, transmission, distribution companies, if the asset is being purchased after 31/3/2005, underline, after 31/3/2005 by an assessee, that's important. Here, as I told you, the risk part is you bought the assets, and you have not installed it. I repeat, you have not installed it. Then this condition will not be satisfied. It means what? You need to have the asset bought. You need to have the assets being installed. It means it is in a running condition. So that is additional depreciation of 20%. What is additional depreciation? Again, going back. The depreciation rate for plant and machinery is at 15% as per Income Tax Act. Now, 15% normal depreciation. In addition to that, you can claim this 20%. So this 20% plus 15%, 35% depreciation you can claim. That is additional depreciation. Now, another condition. If plant and machinery is acquired and put to use for the purpose of business or profession, then as I told you, 50% of the depreciation will be allowable. The same rule will be applicable for this also. Be very clear. Up to 30th September, take the full rate. After 30th September, you should take only the half rate. So that is very, very important. Now going to the next model, there is one more depreciation, additional depreciation be introduced in order to encourage acquisition and installation of plant and machinery for setting up a manufacturing unit in a notified backward areas of the state of Andhra Pradesh, Bihar, Telangana, and West Bengal. A new provision is being introduced, like I told you, section 32(1) plus 2A. New provision has been introduced with a higher depreciation of 35% instead of 20%. So, any acquisition or installation in the state of, that too very important, notified backward area. What is notified backward area will be given in the act. Let us not get into what is the notified area being given. But notified area of Andhra Pradesh, Bihar, Telangana, and West Bengal, and the depreciation instead of 20% additional, 35% will be allowed. I repeat, 35% will be allowed instead of 25%. What is the conditions for this? In respect of actual cost of new machinery, even there, the respect of actual cost. So actual cost of machinery installed, the period between, condition is period between, the installation also should be completed, period will be 1/4/2015 and 31st March 2020. I repeat, 1/4/2015 to 31st March 2020. If you buy an asset and in the notified area, if you have your factory and in the state of Andhra Pradesh, Bihar, Telangana, and West Bengal, your depreciation can be allowed at 35% additional. I repeat, 35% additional instead of 20%. So this is the new provision being given. Now we move on to the next provision. Section 32 AD. I repeat, Section 32 AD. This is a new provision which I'll explain. There will be an additional depreciation of 15% if the following conditions are satisfied. You have to be very careful for examination perspective. Additional depreciation separate, additional depreciation plus specifically they have given for notified area, that is separate. So section 32 AD is for 15%. I repeat, 15% of 15% of amount equal to actual cost of new plant and machinery acquired and installed. I repeat, acquired and installed in the assessment year relevant to the previous year in which such plant and machinery been installed. Conditions, they're giving a conditions. What is the conditions? The assessee sets up an undertaking or enterprise for the manufacture or production of article or thing on or after 1/4/2015 in backward area notified by central government in the state of Andhra Pradesh, Bihar, Telangana, and West Bengal. So this is the similar provision this is a similar provision in connection with the other one. But what is the difference is that is notified in a backward area. This is by the central government. So in the questions you have to be very careful. What is that notification or exemption? That is backward area. This is backward area notified by the central government. That's the difference between these two. Now, next section is section 35. This is very important for examination perspective. Section 35. You all know that many companies does research, many companies does laboratories in that they find new vaccines and they invent a lot of new things. So to promote, to support those companies, the income tax is giving a specific exemption for those kind of companies. So what is that? I'll just brief you. Any expenditure incurred, revenue or capital expenditure, any expenditure being incurred for the purpose of this scientific research. I repeat, scientific research. If they are doing expenses to create some new product or to create any new invention, when they spend expenses, the deduction is being allowed. Underline, deduction is being allowed. I just summarize: expenditure incurred by the assessee, revenue expenditure or capital expenditure. I repeat, revenue expenditure or capital expenditure is allowed for the business or profession at some rate. What is that rate? We will just go through. The rate is very simple. If I spend 100 rupees, I repeat, if I spend 100 rupees for this research, I'm allowed but 150%. I'm allowable at 150%. It means the Income Tax Act is saying you can claim up to 150%. For example, in case of a company engaged in business of biotechnology or manufacture or production of article or thing, deduction of 150% of expenditure incurred on scientific research, on in-house research and development facility is allowed. What is in-house? In-house means the company has their own research R&D department and they create and they do research, and that expenditure is being allowed. So I'll give you an example. Company is having a manufacturing unit, they are doing business. There is one R&D department, research and development department. They are spending expenses to find new products. Now, that new products, expenses incurred, the product is under development. Now we are into, let's say, let us go into a live example. The coronavirus we have, there is a company which is doing research to find vaccine for coronavirus. Now the expenses is being incurred. Obviously, we know it takes time to find the vaccine. Now the expenses is being incurred. Slowly the expenses are going up. 1 crore is the expenditure. Total expenditure is 1 crore. Whether they might get the vaccine, whether they may not get the vaccine, but the intention is to find vaccine. 1 crore being expenditures. This is for in-house scientific and research expenditure. I have a company, ABC Limited. I'm a manufacturing company for drugs, and I'm having a unit R&D. 1 crore I spent for coronavirus vaccine. What income tax says? You claim 150% because you are spending time. You are giving your money. You are spending time, and 1 crore you spend. You claim 1.5 crore as your expenditure. That's the idea of this section, because to promote, the companies will have interest to have research and development department. So there are certain things which has been specified. Notified approved research association, universities, colleges, or other institutions for scientific research. For scientific research, if any university or college, anybody is doing research, spending money, 150%. There are other criteria. Approved notified company for scientific research. There are some companies which get approval from the government to do scientific research. For them, 100% has been allowed. There is no restrictions. Third, notified approved research association universities in social science and statistical research. I repeat, social science and statistical research. 100% of the expenditure has been approved. Next is approved national laboratory, universities, IIT, specified persons to be used for scientific research undertaken under approved government programs. In some cases, government issues some programs and programs, or they issue some notifications where some companies can opt for it. Those kind of specified programs, 150% is allowed. If I spend 1 crore, I can claim 1.5 crore. So this is scientific and research development that you need to be. You read this in concurrence with problems in given. Practice more problems, because as I told you, it is a formula. You cannot change. If it is a central government approval, it is for a specified program. It is a normal program, 100%. Specified program by the government, 150%. These things should be very, very minutely being read. If you have to prepare a chart, and you have to make sure that you are having line by line for each formula, line by line for each rules and regulations been given in the act. You cannot deviate. You have to stick to the formula. I'm always concluding as a formula. It is not an act. It is a formula. You have to follow the formula. Then next section, section 35D. I'm sorry, section 35 CCD. I repeat, CCD. There is a new skill council being introduced by the government of India. So what they are saying, 150% of the expenditure, other than expenditure in the nature of cost of land and building, incurred by the company on notified skill development project. So there is a skill council of India being introduced by our government before, I think, 5 years, and a lot of new skill development has been happening in the country. And those companies, not for land or building, only for development of skill. If you spend expenditure, claim 150%. That is the last 2 pages. Now going to section 35D. 35D section, I repeat, 35D section is very, very simple section. Whenever there is a company being incorporated, I repeat, whenever there is a company being incorporated, there might be expenditure incurred preliminarily before the company comes into existence. There is something called preliminary expenses. These expenses can be allowed in a period of 5 years. For example, for incorporation of a company, let's say you are spending 1 lakh rupees. The 1 lakh rupees is an expenditure as per the Companies Act. You prepare profit and loss account, 1 lakh expenses. But Income Tax Act is saying we cannot allow that 1 lakh, because it is not for the business or profession. It is a one-time fee you paid. You take only 20,000, 20,000, 20,000, 20,000, 20,000 for 5 years. So in the tax part, you will be claiming only 20,000, and in the Companies Act books, you will claim full 1 lakh as expenditure. So this is about section 35D, preliminary expenses. Now section 36. Now getting into section 36, allowable expenditure. Section 36 1 subclause 3 stipulates interest paid on capital borrowed for the purpose of business or profession. Very important. Any expenditure, I repeat, any expenditure incurred for the purpose of business or profession allowed. Now, the same question I will ask differently now. The interest paid for the purpose of business as profession, but when there is a interest paid for the purpose of purchase of an asset, how will you do? So, what is it? When you purchase an asset, I repeat, when you purchase an asset, right? The moment you borrow the money shall be deducted for the 40IA is for payment to residents. 40AI is for payment to non-resident, non-corporate. We read it. So, amount of income tax. Any sum paid on account of income tax.